This is the Chapter 15 exam review of the most missed questions. Before we get into the actual questions, I want to talk about the big picture for the first few of these review questions. They're basically talking about the difference between a static budget and a flexible budget, and which one would be best for performance analysis. Now, a static budget, you come up with one production level, and that one production level is not adjusted for any actual production. Whereas a flexible budget, you have a rolling kind of a set of numbers, and the budget can be adjusted to whatever the actual activity level is. So in a nutshell, the one that these two methods give you the best performance analysis is the flexible budget. So XYZ Company's static budget is based on planned activity at a level of 37,000 units. So they think they're going to do 37,000 units, so that's what they base their budget on. At the same time the static budget was prepared, the management accountant prepared two additional budgets, one based on 32,000 units and one based on 42,000 units. The company actually produced and sold 41,000 units. So in evaluating its performance, management should compare the company's actual revenues and costs to a budget based on how many units. Well, the answer is management should compare actual results based on the actual volume of activity, which in this case would be 41,000 units. Our next question, XYZ Company developed the following static budget at the beginning of the company's accounting period. They thought they were going to do 10,400 units, and that would give them revenue of $20,800. Variable costs were going to be $5,200. Contribution margin would be the difference between the revenue and the variable cost, which would be $15,600. Fixed cost $5,200, and net income would be the difference between contribution margin and fixed cost, which would be net income of $10,400. Now, what if the actual production totals 10,800 units, the flexible budget would show total cost of what? So we got to put together now a flexible budget, and that's going to be based on what we actually did, which was 10,800 units, not 10,400 units. So to make this total cost budget up, and remember, total costs are equal to two things: total variable cost and total fixed cost. So based on 10,800 units, the flexible budget would be as follows. It would be the total of all the variable cost at that level, 10,800, and the total of all the fixed cost at this level. So here's what it looks like. We've got to find out our variable cost at this new level of 10,800 units. You want to take the previous information you were given at the top up here and say $5,200 was what my variable costs were at this level of production. So if I divide 10,400 units into $5,200, I'll get a certain amount, which is a level of the variable cost per unit, and then I'll multiply that times the new level that they're operating at, which in this case is 10,800 units. So that would be the way to figure out what the variable cost would be at this new level of activity. Then I'll just add to that the fixed cost of $5,200, because fixed costs, whether we're using 10,800 units or 10,400 units, won't change. And I'll add these two together, and the answer that we're going to come up with is 10,600, but I'll now go into some more details of how we come to the actual pieces of this. So the next step you would do, once you divided the 10,400 units into the $5,200 total variable cost, you would get a variable cost per unit of 50 cents per unit. Now that 50 cents per unit is going to be multiplied again times 10,800, and that's the total variable cost piece. The $5,200 would be the fixed cost piece. So when you multiply 50 cents per unit variable cost times 10,800 new units, so that's the new level we're operating at, you get a total variable cost of $5,400. Your fixed costs stay the same, and the answer that we're looking for here would be a total cost of $10,600. Remember, if you want a fair comparison, you don't want to use a static budget. You want to use a flexible budget. In this problem, it's going to test to see whether you understand the difference between fixed cost per unit and fixed cost in total, and how they relate to a company that is producing units that are within the relevant range of activity. So here we go. Remember, do you understand the difference between a fixed cost per unit and a fixed cost in total? XYZ company developed a static budget at the beginning of the company's accounting period based on an expected volume of 5,000 units. So this is what we thought the costs were going to be per unit based on 5,000 units. Now, if the actual production cost or actual production totals 6,000 units, then and it says that 6,000 units, which is within the relevant range, the flexible budget would show fixed costs of what? Well, let's do this. Look at our information that we originally were given up in the top. And so based on 5,000 units, we had fixed cost per unit of $3, which translates into total fixed costs of 5,000 times $3 per unit. That was the fixed cost per unit, or $15,000. So the total fixed cost up here was $15,000. And if we change our units from 5,000 to 6,000, that means we're still operating within the relevant range. And all this means is that we're still operating in a situation where our fixed costs are not going to go up in total. So therefore, whether we produce 5,000 units, 6,000 units, and probably even 7,000 units, we're still within the relevant range. So our fixed cost with a budget based on 6,000 units will still be the same $15,000. So this amount is unchanged if the flexible budget is prepared at a level of 6,000 units. So the answer here is that fixed cost, you had to figure it based on this per unit information, and you got 5,000 times $3 or 15,000, and so fixed cost, even if you change to 6,000 units, still going to be $15,000. In this problem, we have a static budget, and we have sales are $70 per unit, and the total sales for this static budget are $840,000. Then we have variable costs are subtracted from these sales, and there are two variable costs, which are manufacturing costs at a level of $30 per unit, and this gives us a total manufacturing cost of $360,000. And we have variable selling and administrative costs, which are $20 per unit times that gives us $190,000. Then we have a contribution margin per unit of $20, and that gives us a total contribution margin of $290. And then we have fixed costs of the problem. Manufacturing costs are $78,000. These are fixed costs. Selling and administrative costs are $127,000. Total fixed costs are the sum of these two, which would be $205,000. And then our contribution margin minus our fixed cost would give us net income of $85,000. Now this was all based on a static budget, and they want to know what will be the volume variance if 15,000 units were produced and sold. Well, volume variance is the difference between the static budget number and our actual level of production, which was 15,000 units. Well, we don't know what number of units we made up in this static budget, but we can figure that out by taking the 840 and dividing it by the selling price per unit. That's total sales dollars divided by the selling price per unit, and get the number of units in this budget. And the way we do that, or rather when we do that, we'll come up with 12,000 units. So this budget is based on 12,000 units, and the way we got this again was taking total sales, dividing it by the selling price per unit, and that's 12,000 units. Now we know what's the overall volume variance if 15,000 units are actually made compared to the 12,000 units in this static budget. So what does it mean when we say overall volume variance? Well, overall volume variance means, in this problem, it means currently we're making a net income of $85,000. What will be our net income if we make 15,000 units, and that will be the overall volume variance. So let's do that. So here's our 15,000 units we actually came up with, or actually produced. And we're going to have three columns. What happened under static budget, what happened under the flexible budget based on 15,000 units, and then the volume variance. Our first one will be static budget. From the information above here, we had sales of $840,000. Our sales under the flexible budget will be $1,050,000. Well, how do we come up with that? The way we come up with that is take 15,000 units and multiply it times the selling price of $70 per unit, and that'll give us $1,050,000. The difference between the sales at the static budget level and the sales at the actual level we came up with, which was 15,000, gives us a favorable volume variance of $210,000. It's favorable because these sales numbers were higher, actual numbers were higher than what we planned for. Now, and again, that little asterisk there just means that we're operating at a level of 15,000 units. So our next cost is a variable cost. It's variable manufacturing cost. And under the static budget, it was $360,000. Well, under the flexible budget, it's going to be $450,000. And the way we come up with that $450 is to say, okay, we're going to operate at 50,000 units, multiply that times the $30 per unit, and this will give us $450,000. That difference is going to be a difference of $90,000, and it's going to be unfavorable because this flexible budget number is higher than the static budget number, and it should be because we're making more units, right? We're going from 12,000 up to 15, so that should be, our variable cost should be higher. Next, we have variable selling and administrative costs. Under the under the static budget, we have $190,000 total, and under the flexible budget, we have $300,000. And the way we get this $300,000 again was take 15,000 units and multiply it times this $20 per unit to come up with a total of $300,000. Then we'll compare that to the static budget level of $190. In this case, we'll have more costs that are under the flexible budget of $10,000, and it's unfavorable because it's higher, but it should be higher because our volume's higher. Next, we'll have a contribution margin, and that contribution margin is really just sales minus these variable costs to get $290. So we got $290 here, and under our flexible budget, it'll be sales of $1,050,000 minus these looks like $750,000 worth of variable cost to come up with $300,000 worth of contribution margin. And it looks like the overall difference here is going to be $10,000, and it's favorable because the actual contribution margin is higher than what the static budget called for. Next, we'll go to fixed costs. And these fixed costs, they don't change. So whether it's static budget or whether it's the flexible budget, they should be the same. So there's no variance there. Same thing with the fixed selling and administrative cost. No difference there in the flexible versus the static budget because they're fixed costs because they don't change. Now when we add all these things up together in both these situations, we will end up with a static budget like we had up here, $85,000 is net income, versus the flexible budget, which our income was $95,000. So therefore, we end up with a total volume variance of $10,000, and it's favorable. In this problem, we've got a static budget, and we are given that the static budget gives us units under the static budget of 25,000, sales 300,000, and then we have less variable expenses or variable cost of manufacturing costs that are variable of 87,500, selling and administrative costs, which are 65,000. The difference, you add these two together, these two variable costs, subtract from sales, and you'll get a contribution margin of 147.5. Then you subtract all fixed expenses of manufacturing costs of 32.5, selling and administrative costs of 16,250, and add these two together, subtract those from contribution margin, and come up with that income. So that's all of our given information. They want to know what will budgeted net income be equal to if we make and sell 23,000 units? Remember, we're operating at 25,000 units here. What will be the income if we have 23,000 units? And here's the way we go about doing that. Here's our 23,000 units, and we start up with a flexible budget because that's what we actually produced, right? 23,000. So our sales will be 300,000, that was the old under the static budget, divided by 25,000 units, and this gives us a selling price per unit when we do that. That is, take the units that we had under the static budget and divide it into the total sales dollars to get a selling price per unit. That was $12, and multiply it times the new actual units that we actually sold and produced, which were 23,000. This gives us sales of 276,000. Now, as I go through this flexible budget and make these calculations, I want to apologize for this not all lining up on the same rows that we have over here. They're going to be down through here, but they won't be exactly lined up. But I can't do that because I didn't have enough room. If I made them smaller, you wouldn't be able to see them probably. So let's go to the next situation. Our variable manufacturing cost, the first one will be this manufacturing cost of $87,500. How do we convert that to a level of 23,000 units? Well, what we do is we take the 87.5, divide it by 25,000 units, that was the static budget number, and get a cost per unit. That happens to be $3.50. We'll multiply that times the new level that we actually achieved, which is 23,000 units, and we come up with variable manufacturing cost in total are going to be $80,500. Let's take a look at the next one. Variable selling and administrative expenses, our costs, are going to be that static budget level of 65,000 divided by the 25,000 units that we had under our static budget. This gives us a per unit cost under this type of cost of $2.60 per unit. We'll multiply that times the 23,000 units that we actually achieved, and this gives us total variable selling administrative cost of $59,800. Next, we've got fixed expenses, and next we have contribution margin. So contribution margin will be the two variable total cost of $80,500 plus $59,800, add them together, subtract them from the sales to come up with contribution margin of $135,700. Now we have manufacturing expenses that are fixed. We'll subtract those from the contribution margin, and they don't change, right? Whether we make 25,000 units or 23,000 units, these fixed expenses don't change. So 32.5 over here, 32.5 over here. We'll subtract out the fixed selling and administrative expenses, which were $16,250. And now these two fixed costs be added together, subtracted from the contribution margin to come up with net income, and the new net income is $86,950. So what will be the budget net income if we make 23,000 and sell 23,000 units? It'll be $86,950. The next question in this review of most missed questions deals with standard costing. And just to give you a brief summary of what standard costing means to a company would develop standard costing if they want to improve quality and basically have no surprises. Now, this question is a little bit, I won't say misleading, but it's making sure you understand the difference between standard costs and actual cost, and what you can use to, you got to pick out what is relevant here to solve the problem. So let me just go right to what the problem is asking first of all. The problem wants to know what is the actual manufacturing cost per unit. That's all they want to know, no more, no less. Now they gave you the following information, which a lot of this is really not relevant to what we're trying to find, but it's something that might keep you thinking a lot more than what you really needed to solve the problem. But anyway, here we go. So it says the following standard cost card is provided for XYZ company for product A. Remember, these are standard costs, what it costs to make a certain kind of product. So they use standard costs. They're supposed to use direct materials. They're supposed to use 3 pounds at $4 per pound, which is $12. They're supposed to use direct labor, 2 hours, $6 per hour, $12. They're supposed to use variable overhead 1 hour at $2 per hour, which is $2, and they're supposed to use fixed overhead 1 hour at $3 per hour, $3, to come up with the total standard cost per unit of $29. That's what they're supposed to make the cost to make a unit. Now they also tell us that the fixed overhead rate is based on total budgeted fixed overhead of $13,000. During the period, the company produced and sold 5,200 units at the following cost. And when I say the following cost, these are actual costs. So direct material was 13,000 pounds, $3.50 per pound. That was what they actually used. And direct labor was 4,950 hours of labor that they actually had incurred at $12 per hour. And they actually had overhead of $29,960. And they tell us again, repeating, that the standard manufacturing cost per unit is $29. Well, that's what they told us right up here also. And again, what they want to know is, what is the actual manufacturing cost per unit? Okay, well, that is this. The actual manufacturing cost will be the actual cost of direct material, the actual cost of direct labor, and the actual cost of overhead. So in this problem, the actual manufacturing cost will be the direct material of 13,000 pounds at $3.50 per pound, the actual labor of 4,950 hours right up here at $12 per hour, and the actual overhead in dollars, which was $29,960. Add all those together, and you get $45,500 worth of material. That's 13,000 times 350. $59,400 worth of labor. That's $49.50 times $12, and of course the overhead, which is $29,960, to give you $134,860. That was the total manufacturing cost. They want to know what was the actual manufacturing cost per unit. If that's total manufacturing cost, actual manufacturing cost, to get the per unit amount, we take this number and you divide it by the actual number of units we produced, which were 5,200 units, right? The company produced and sold 5,200 units at the following cost. So the answer here is going to be the 5,200 units divided into the actual cost, which makes the actual cost per unit $25.93. You see that that's really lower than the standard, but we don't really care if it's lower or higher or whatever. That isn't what they ask us. They just ask us, well, so what was the actual manufacturing cost per unit, which is $25.93. The next 4 questions on this review, which are the last 4 questions on this review, deal with residual income. Residual income is a term that basically answers the following question. Did the division, and you were talking about this is a large company that has several different divisions, did the division create more income than management expected? So they would have an income statement for this division, and is it higher or lower than what the management expected? That's what these questions are all about. They all were trying to answer this question. So let's go to this next question that starts off with one way to calculate and how all the ramifications of what residual income, the calculations are. So here's our question. XYZ Company provided the following selected information about its consumer products division for the year. The desired return on investment was 7%. Net income for this division was $263,400, and residual income was $220,000. So, based on this information, the division's investment amount, that is operating assets, were what? Well, all this information here is really the pieces that you need. I'll just show you here. Here's a calculation for residual income. Residual income is equal to the operating income for a company minus, in brackets here, minus the operating assets times a desired return on investment. Now there's 4 pieces here. We've got residual income, that's on one side. We got operating income minus operating assets and desired return on investment. 4 pieces, 1, 2, 3, 4. The problem gives us 3 of these 4 pieces, and we're trying to solve for the unknown piece, which in this case is operating assets. Okay, so let's just fill in what we know so far. We know that based on the problem information up here given to us, we know that residual income is $220,000. We also know that operating income is $263,400, and then we also know that the desired return on investment was 7%. So this isn't that difficult, but it does require a little math. So if this side's 220, this side's got to be 220. And if this side's 220 and this piece is 263.4, then this piece, this thing right here, all this information right here, has got to be 43.4, right? 43.4. Now, and the way we get that is 220 is equal to 263.4 minus, so 263.4 minus 220 is going to be 43.4 right here. So just keep that in mind. This whole thing's got to be 43.4, and then we'll get to calculating what operating assets are in just a second. All right, so operating assets times 7% is equal to this, like I said, this 43.4. So if you take 43.4 and divide it by 7%, you'll get what the operating assets are, which are $620,000. Let me say this another way. If you knew, so you can check yourself by saying, okay, if we take $620,000 and put it in right here and say, okay, $620,000 times 7%, that's going to equal our 43.4, and back in the original equation it was 220 on this side, it's got to be 220 on both sides. So if this residual income is 220, then 263.4 minus 43.4 will give us 220. XYZ Company reported the following information for the current year. Sales $820,000, average operating assets $320,000. Desired return on investment was 12%, and net income was $52,000, and they want to know what was the company's residual income. Well, here's our formula. Residual income equals operating income minus the operating assets times the desired return on investment. So we'll fill in what we know. We know that operating income was $52,000. Operating assets were $320,000, and then we know that desired return on investment is 12%, and we know that if we took 320 times 12%, I don't have it listed up here, but that's $38,400. So 52,000 minus this 320 times 12%, which is 38.4, so 52,000 minus 38.4 should equals our residual income of $13,600. And let me say one more thing here. Notice I said that residual income is income over and above what we expected the division to do. Well, what we expect the division to do is come up with a return on an investment of at least what we're used to getting. So they're used to getting 12% return on investment. So if they can take the operating assets of this division, the one we're talking about here, and multiply it times this 12%, they expect this company to earn $38,400, but instead, no, they earned $52,000. So they earned more than what was expected of them, and therefore there is a residual or extra, excess, whatever, income of $13,600. The next problem starts with XYZ Company reported the following information for the current year. Sales were $799,000. Average operating assets were $387,000. Desired return on investment was 12%, and residual income was $11,850. So they want to know what was the operating income for the year. All right, this is one of these pieces, things where we got 4 pieces. We know 3 of the 4 pieces. We can find for the unknown piece. So there's residual income that was given to us, $11,850. Operating income, that's what we don't know. We don't know that, but we do know that the 387 with the average operating assets and the 12% was our desired return on investment. So if we multiply 387 times 12%, we'll get that this number is $46,400. Excuse me, $46,440. So if residual income is $11,850, and if the desired profit that we should have made was $46,440, then we know that the operating income has to be more than this $46,040, which will be as follows. The operating income will be the $46,440, which is this 12% times 387, plus the $11,850, and this will give us a total of $58,290. And you can check yourself by saying $11,850 is equal to the $58,290 minus this $46,440, and that's correct. Our last question deals with the company that has, let's see, the new products division of XYZ Company had operating income of $8 million, operating assets of $44,800,000 during this current year. The new products division has developed a potential new product that will require $8,500,000 in operating assets and would be expected to provide $1,400,000 in operating income each year. XYZ has set a target return on investment of 16% for each of its divisions. Assume that the new product is put into operation. Calculate the residual income for the division. So we're going to have a calculation just like we've had before. You know, residual income is equal to the operating income minus the operating assets of the division times the desired rate of return on investment. The only difference in this formula is we're going to add into this the pieces that related to this new product that we're trying to put together. So our formula now changes to the following. Residual income for this division is equal to the operating income that we have in this division plus the new products operating income minus the operating assets of this division, adding to those operating assets the new products operating assets. And all of these things are then going to be multiplied times the desired return on investment, which was 16%. So let's fill all these pieces in, and we'll come up with a residual income for this division that includes this new product they've just developed. So $8 million, which is the operating income of the division, and then we'll add to that the new products operating income, which was $1,400,000. We'll subtract over here the sum of the following things: the operating assets of the division plus the new products operating assets. Add those two pieces together, multiply times the 16%, and when you multiply all that together and subtract it from the operating income, which includes the operating income of the new division, you end up with residual income of $872,000. And that's the end of the review. Good luck on your exam. See you on the flip side.